Hi, this is Randy Finney with Right Side of the Chart, and this is an early session update for Tuesday, October 22nd, 2024. It's 11:37 a.m. Eastern Time, so we're a couple hours into the trading day. Posts have been light lately. I haven't done a video in a while. There's just not a lot out there that really stands out right now. So, trickling trade ideas out to you, trying to show you, the best things that I see, and it's just not a whole lot right now. So I am going to do updates on most, not all, but a lot of the trade ideas I've shared recently and go over the markets. That's what we're going to start with, just kind of a brief update. And that's also another reason there haven't been many updates. We've gone absolutely nowhere now for over a month. I'll get to that. Here's what I'm going to try to cover. Starting with the equity markets, a few things there. I'm going to segue into the semis, because that's, to me, very related to especially the tech-heavy NASDAQ 100. Going to go over some of the stocks that have reported, like the banks, but very briefly, just a quick update. And then the defense stocks. We had a lot of the defense stocks report today and have another big one coming out tomorrow. And any other sectors that stand out, home builders, mortgage related companies. We've got a couple trades on those. And that should be it. I won't go. If I have time, I'll get into the commodities. I give you an update on nat gas today. There's a level we need to pop to trigger the next buy signal. Still like the grains right now. I'll try to get to those. And if not, I'll do those in a separate video, because I don't want to I want to keep this video, relatively short, 30, 40 minutes max. All right. QQQ. This is a weekly chart. This goes back all the way. Well, we can go back as far as we want. But back here, give you a market top range before we got there in late June, somewhere in here. And we went up in that range. And we're still in that range right now. And does, kind of what was expected if the Fed cut 50, which they did, that we'd go back into the range. And that's what we've done. So we're in that range. I have the long-term targets. Remember, we hit two of those targets already. We reversed right there. So it's, call it a new trade, call it the same trade, call it whatever you want. These are still the same long-term targets that were laid out back then in late June, targets that I still maintain. Again, when did things change? When we, clearly take out the top of that range, and we haven't. So just talk about the market going sideways. This is QQQ. We're looking at a weekly chart. That's where I give you those targets on. This is where we're at right now. If I put the crosshairs, we're trading around 494. It's the same level we were trading last week, same level we were trading the week before, and same level we were trading 5 weeks ago or 4 weeks ago, so over a month ago. And that's it. So right there at the highs from a few weeks back. So this is it. So we've gone down a little, we went up a little, a hair above that, back to right there where we peaked out, over a month ago. So that's it. I can't provide updates on anything that hasn't changed. By definition, as an update is kind of what's going on, and this is your update that nothing has changed. So, and QQQ is just one of the big indexes. The S&P 500, which again, when the Fed cut 50, which they did before that meeting, I said that would probably take us up towards the high end of my final market top range, where we remain right now. That's it. Same range given back in late June. And the divergences, everything's still intact. And so that's it. So S&P's pushing the upper limits, but QQQ is still comfortably in that market top range. And that to me is the big one, the more important of the two. I'm going to borrow this little trend line right here and add it, because I have it on a lot of different boards. That's really what I'm watching now, most importantly on the indexes. And the uptrend lines, you can see it here on my daily chart. The uptrend lines off the August 5th lows, a key low. SPY looking like it's poised to break down. It's a nice little wedge type pattern. Call it what you want, but I think it'd be hard for anybody to argue that that's not a significant trend line, and you'll most likely see some sellers step in if and when it's clearly taken out. What does that mean? Well, right now you can say we're trading below it, but you have to roll in and squint. And I always say if you have to squint to see if you've taken out, a breakout, see as I scroll here, then you move above it. So if you have to squint to see if you're above or below a trend line, give it the benefit of the doubt and say that you're not. What you want to see is a big red candle down through there, whether it's today, tomorrow, or 3 months from now, if that trend line continues to extend. This is what QQQ looks like on the 60-minute chart. This is our uptrend line off the August 5th lows. And it's only a okay trend line because you have two distinct reactions. I mean, there's a few more candles there, but that's a cluster right there. And so it's just kind of sloppy is all it is. Again, we're grinding around. The momentum indicators continue to diverge, meaning as we're, in a uptrend since the August 5th lows, but we're still below those previous highs. So again, just like it's a go nowhere market. If you look at it, from a longer term perspective, going back even a few months there. So, all right, enough on that. There's nothing else to add. If we take out the top of the market top ranges, it's most likely has the potential to change the technical picture. What does that mean? You still have the same divergences that were in place at this little divergent high and with that little correction are in place. They've gotten larger. If we happen to eke out marginal new high, again, anytime if we're staying within this market top range, which is still my preferred scenario, and we get up to the top of it anytime soon, you'll have negative divergence. If we get much above there or something else, maybe we grind around sideways for a while, maybe the divergence goes away. But right now I have it on all time frames from that 60-minute chart all the way out to the weekly chart. Again, if we already put in, just to be clear, on the NASDAQ 100, we put divergence back there. That's the high so far. If we equal that high or make a marginal new high, you can see by the lines there will clearly be still negative divergence on the weekly, just like we currently have on SPY, which is closer to testing or just above those previous highs right there. Still big divergence. So that's it. We got a big election coming up. I won't speak too much of that. Everyone has their own opinion. To me, my opinion is, I believe these are literally the two worst candidates we've had in the same race in the history of the entire country. That's my thoughts. But again, maybe it doesn't matter. When you get a split Congress, nothing happens, or very little happens, or you get a puppet in there, and the powers that be pull the strings. But we'll see what happens to the stock market coming around that time. There's nervous selling or not. I don't have a prediction to make for you guys. All I can tell you is let the charts be your guide, and we'll see where this clown show goes in a couple weeks here, or which way the clown show goes. Okay, let's go to, since there's really not much. Oh yeah, let's stay on the markets real quick. Something I want to show you. I've covered this many times over the years. I don't do it very often, but I did do it back here recently. This is what something I came up with many years ago, and I've shared with you many times on this site. It's called my low volume indicator. I use it on the major indexes. You can see down below, if you can't, I'll make it bigger. I have the volume below. I really track SPY and QQQ mainly. And I have these extreme levels. The yellow line is current extreme. Now, over time, those levels may change depending on market conditions. Volume may be higher or lower. But what I do is I overlay a 10 period exponential moving average on the volume, and that helps smooth out any irregularities such as holiday. You have abbreviated trading days sometimes, things like that. So when the 10-day volume, sometimes it's this purple line, but the extreme right here is a yellow line, and you can see here, I'll just scroll back a little bit. So I warned of it back here a few months back, and we had the biggest correction in years right there, and we caught it. We caught every bit of it. We were short QQQ. We're short off the highs. We literally covered the pennies within the low that morning of August 5th. But that low volume indicator was highlighted ahead of time as a warning. Correction was likely, and we got that. Even the media referred to it as a market crash. I told you, to me, it's just kind of a run-of-the-mill. It was impulsive, especially in the tech-heavy NASDAQ. But so where am I going with that is, so sometimes you get that double tap reading. So you hit it, you can see. Let's go all the way back. Okay, so this is it. We had it there, And we've reached some kind of new crazy low level here. Again, this is the SPY S&P 500. Look at the 10-day exponential moving average. We've never in years, even pre-COVID, seen that level hit down. This is as far back as I can scroll. And so what happens is it's a red flag. What does it mean? Why is it a red flag? Okay, this is TA 101. I use a lot of trend lines, hot price support levels, chart patterns, but I very much incorporate volume into my trading. It's gotten harder in recent years. There's a lot of, the black box trading, all this other stuff. But overall, it does a good job of confirming or non-confirmation of a rally, and so that's it. So when the market is heading higher, especially after an extended uptrend, all of a sudden it starts to rise on fumes. What does that mean? Well, if you're only looking at the price action, you're saying, "Man, that's super bullish to going up," and it is. However, if volume is plummeting, what it means is basically nobody's selling. Short sellers have left the building. That's what tends to happen towards the end of uptrends. And you get that first shot across the bow. So follow me over here. Back in 2021, you had the signal was hit right here. You got the correction. And then what happened? You started rallying again, and then volume plunged again, and then the top was in. Most that was bear market by all metrics, really the old metric, back in 2022 until October 2023 lows. And again, that signal has not triggered since, and so there's that initial shot across the bow. And to say that the market's been rising on low volume would be a gross understatement. Again, based on, you can see this indicator here. So that is. Certainly a yellow, if not a red flag. And here's QQQ, same thing you can see here. I'll shrink it down here a little bit. You can see the red line right there. That same line I shared back then before we had that's what was it, 17% drop? I'm going from memory. Right there in QQQ. Again, one of the biggest drops in many years. Or at least in last couple of years. And then boom, look at, we hit it again. We're actually now below the red line. So you can see back here, we had couple warning shots, volume drop. We had some big corrections there. And then shortly before the top was in, you had that initial shot across the bow. You had a surge in volume, which is common when you have a correction. You're going to see volume spike up, just like you did here. And then you saw volume come down to not the extreme that the S&P hit, but pretty close. And so that's that. So I just wanted to mention that these are flashing definitely yellow flags for the market. And by the way, it's not just a seasonal thing. You can go back and do it yourself, replicate it with a 10-day moving average, and look back at other times when we were in October, what the volume was like. You could see a lot higher back then, or even in recent years. Okay, we'll talk about a few sectors. I can't possibly get into them all, even the ones that I've highlighted recently, but the big ones I'll try to hit on real quick here. Semis being, I always say the canary, the coal mine for the tech sector. Tech sector is by far, without a close second, the most important and largest sector in the stock market. Nearly half of the NASDAQ 100, roughly half, and then over a quarter of the S&P 500, by far the largest weighted sector. So, and then the semis kind of give you a heads up on where the tech sector is going. So, SOX was thrown out as a trade idea. On that, I gave a suggested stop of 239.42, which was you have to squint to see if it was hit. You can consider it stopped out. You can consider it not. Whatever you want. All I can tell you is I still like this one right here. You had a divergent high. Well, we shorted it right. I think it was on that break right there of that trend line there, and we went down. We hit my first target, bounced as expected, put in an ever so slightly marginal new high, and then went on to we went on to form a secondary uptrend line. You came in, you had reactions here, several along the bottom there, all the way up here, danced on it, and then took it out after simply extending. DH1 means this was, the first divergent high. Actually, it's been extending here. It's really DH1, 2, and 3, if you look at it that way. But more so, this one, I'm going to remove this line here. Let's just focus off this, call that DH1, DH2. And that's it. Big move down, impulsive selling. I put a little support level right here because that's what we've been dancing on the last few days. And, we've got a lot of big, we're in earnings season, so we have more and more techs coming up. This has been, believe me, this would look a lot worse if you lift up the hood. Remember, we talk about market internals a lot. Market breadth. The internals in the semiconductor sector are pretty poor, very poor. It's that one stock that just like has the effect on the NASDAQ 100 and the S&P 500, it's NVIDIA. So if you back out NVIDIA here, these guys would be a lot lower. And I've done quite a few videos on the semis, even in recent weeks. You can revisit those. And so to me, the sector is still looking bearish. I've given you and still maintain long-term targets. Those were back here. So depending on how you're trading it, we put in a big divergent high there, wedge break, hit the trend line, which was my second price target. This was the first target hit here. Second price target was a trend line right there, hit here twice. We covered both times. This is just pretty much how we're gaming a longer-term trade. Both times there where it's highlighted to cover shorts, go long, including NVIDIA, things like that. So basically, this is the trend line that needs to be taken out now. That's T2. We've hit it twice. Once we take it out, now T3, keep in mind, T3, we already had a reaction off that level. So I could easily see us, and would even lean towards us going down. There's a big thin zone. I don't know if you can see it here. I have my volume at price histogram bars kind of muted and turned down, but there's a big old thin zone right there between T3 and T4. So just keep that in mind, that if and when that goes, we'll probably shoot right down through T3 with little, if any, reaction, go to T4, get a reaction, and then continue on down to these deeper targets down there. Oh, so that's your updates there. NVIDIA, that one clearly hit the stop. NVIDIA, well, depends on if you're looking long-term trade, short-term trade. The most recent short-term swing trade, and I kept stops tight on it. So we had a 3.7% gain. I'm sorry, 3.7% loss. The stop was at 141.60. The short entry was, I think, right here after the break of that the wedge of the trend line. Yeah, it was entry was break on that trend line. Just kept it really tight, and that one we hit T1. We had that brief momentum fueled overshoot, bounced off T1, and still looks very, very, very similar. Still like it. That divergent high that we had in place there is simply just extended. That's it. That's all we've done here. We hit the first target, bounced as expected. Kept stops tight on this one just because of the resiliency in the market lately. So whether you're in it or not, I can tell you it still looks good. But at this point, I wish I could draw a better trend line for you. I just can't. I don't like to force trend lines. I could draw that one. I could play around. I think it's just probably going to roll over on its own. It's again, it's testing the previous highs from back here. That was a downtrend line it took out, and that in itself was bullish. So there's your update on it. You can see big, the same divergence we had here is only grown larger on this, ever so slight marginal new high there. And again, the rest of the sector, it would be, if my call on where the stocks is going, the long-term semi, and if the majority of those stocks, they'll have to fall to get there, it would be extremely unlikely NVIDIA is going to buck the trend and go up. Birds of a feather flock together. And so, anywho, I can't give you like I said, the only thing I could tell you, if we fall back much below there, then you have a failed breakout. And again, this thing's drifting up on fumes. A lot of things are, especially the market. So, that's your update on NVIDIA. Let's see. Let's just roll to banks since we're talking about the stock market. So I was going to update the video I did a couple weeks ago. We were heading into earnings, and the banks. The banks are the first big sector in the market that all report, they cluster around the same time, and they're out of the way now for the most part. They'll trickle in here and there, but we had the regionals and the big banks report. And I went over the charts, give you my opinion. The majority of those charts were bearish, and so I played the game where post earnings, how the chart's going to look. And I always say, and repeatedly said in recent videos, it's not the reaction the day of or the following days. It's where's the next major trend, the 10% plus. I just want to say it's undetermined right now. We did have an initial pop. Again, most of those banks reported in the last week or two, and we went up a little bit. This is just a daily chart, ever so slightly, popped that previous high right there. But you can see that breakout has failed, and it failed pretty impulsively, and they've been selling off. So again, you can't declare, the Bears win or Bulls win. The initial reaction, it was kind of muted a little to the upside, but they faded 100% of it and then some. And again, I could go through each individual bank, but that would just take a lot of time. So you want to look at it collectively. I did note over the weekend we've had two failures recently. I monitor, and I don't cover half of what I monitor a fraction of what I monitor on the site. But one thing I do keep an eye on is the FDIC, the failed bank list, and we've started to, for a while there. I don't see how a bank could possibly fail because they were backstopped ever since the collapse. You remember last year we had the second, third, and fourth, or second, third, and fourth and fifth largest bank failures in history, starting with Silicon Valley. And the Fed backstopped the banks, said pretty much you can give us they were all most of them technically insolvent, a lot of them due to their underwater treasury holdings, and the Fed said you can backstop, give them to us, we'll let you put them, we'll let you put them on the books as par, face value. In other words, just take a magic wand and erase those losses. Paper losses. Anyways, one of the ones that failed, I think they talked about some accounting fraud, but we're going to watch that anyways, because KRE, that's the regional banking sector, and you can see again they had a little earnings, they were lifted. When you're backstopped by the Federal Reserve, how can you not have a good quarter? But you can see that they've been steadily selling off since. I just wanted to mention that. And again, you can't declare it as, that's super bearish or anything like that yet until the trend lines break. There's that wedge. You can see the wedge I have and have shared with you on KRE right there, big rising wedge. So that's what needs to happen. We need to, get back below that resistance level right there, that shorting zone. And then what was it on KBE, the banking sector ETF? You can see the trend lines. There's your first minor trend line, and then the more significant primary uptrend line, and that's when we can say definitively, yeah, that was a good call. The charts were clearly bearish heading into earnings, and that's the direction the banks went afterwards. And so my read is correct. This is where the banking sector will be in a few weeks. Come down to the 200 days. Still has about another, it's already pulled off a little bit off the highs, but about another 10, at least another 10, 11% downside there. But you need to take out those trend lines. So there's your update on the banks. Another somewhat related sector, right after the Fed, we shorted treasuries and bet rates would rise, even though not the whole world, but obviously not us, but most folks on CNBC, they were dumbfounded because the Fed cut rates. It was supposed to help the consumer, help the mortgage market, but the opposite happened. Long-term rates went up. So we know that happened, and other than trading treasuries very profitably, we also shorted these mortgage companies, Rocket, and you got an update the other day. We took out, we hit T1 there, almost hit it there, came up, had a perfect reshorting up. If you covered or wanted to get back in, or if you missed the trade initially when we shorted it here, wherever it was, you had a objective short entry. Remember, support once broken becomes resistance. So this one played out very nice. And then now it's below there. We took out yesterday, T2, the trend line was hit and taken out in one fell swoop. We're below it. We have three sister trades with that, UMC, which is now coming up on T2. I'm sorry, I can't remember exactly where we entered this one, but I can just tell you from this divergent high and bearish coughing candle, not that weird, that's where we shorted it, was after that, but it's already down 32%. This one here, and it's coming up on T2. Coop, right on the trend line. This is Mr. Cooper, big mortgage processor, and look at that. beautiful uptrend line. T1 was the first target. We had a bearish engulfing candle, divergent high, and when that breaks, that should open the door to these other targets. And so this kind of speaks to me, larger what's going on. The Fed's lost control. And maybe it all changes, but if rates keep going up, with every tick now, you're going to start to see more sensitive, and you're already seeing it. This is again why we're trading these short. This is the sensitivity to rising rates, and again, the market should be a little concerned because the Fed's lost control. When they bring the federal funds rate down to zero, or whatever they bring it down, when they cut it 50 basis points, if they cut another 50. It doesn't help you or I. In fact, it hurts you and I, because you and I have our money in, our slush funds sitting in a money market fund at either your bank or your brokerage savings account. You were getting 5.5% for the last couple of years, last year or so, and that now you're losing that. You lose a lot of interest income. Corporations too, especially cash-rich companies like Apple and all that have been earning a lot of money on money market instruments. Anywho. What helps you and I is when the 10-year Treasury goes down. That's when mortgage rates go down, car loans go down, things like that. And so the opposites happened, and markets been kind of just holding up the gains. I already covered the markets earlier. Again, I can't guarantee that's going to happen. I'll do an update of Treasuries, but I've given you my long-term thoughts on where rates are going. We're going to trade Treasury bonds. I don't care if I'm just like the stock market. My long-term outlook or bias is not going to affect my positioning as a swing trader. You know me, and you've seen the trades recently. Long, short Treasuries. Same thing with gold mining stocks and everything else. Long, short off the 60-minute charts. And then, occasionally I'll highlight swing and trend entries off the daily chart. This is PennyMac, PFSI, another one there. And remember, we hit the T1, the first target there. It had a divergent high, bearish engulfing candle. And then it broke this minor uptrend line, hit our first target. As expected, bounced. Had a reaction in time for a few days, bounced. And then the first target was the first of the 106 level and the trend line, because they come in roughly together. But I just want to point out we're testing that trend line now. So if this one moves down much lower, especially a solid daily close below, that should open the door to T2. And and the more these guys drop, I think the more concerned the market will be or should be. Okay, and then also on a related note here, that's why my brain's working tangentially here. I'm looking at mortgage companies, and so they're not doing so hot with the rising rates. So obviously, because they're not generating as many new mortgages and refis. What about the home builders? Well, most people buy a new home with a mortgage. Not everybody, but most folks. And here, so you can see the builders put in a divergent high recently. They broke this trend line here and have been rolling over. And based on this chart, look to be headed a lot lower. I've shared my thoughts. Minimum target, swing target down here at about 96.93. It's going to be a drop of about almost 20%. XHB is another one you can use. Same story. I highlighted this recent back here, and no different. Marge ever so slightly, marginal new, and still divergent high, cracking this minor support here about 120 and change right there. If it can close much below this level here, below that 120-ish support, that should open the door for a move down to these deeper targets. Any and all the lines on this chart with a preferred intermediate term swing target, the uptrend line right there. Okay, that's the home builders. Okay, so I covered the banks, which again collectively majority have had that either an initial pop. But what that was all faded, as I covered, and I did the whole earnings video on those. And again, there's just too many individual banks to go through. But that's what's happened as I used the banking sector ETFs. But now another sector that's kind of on my radar as of now, this is a new trade idea for you, trade setup, are the defense stocks. So the aerospace and defense, there is an ETF for it. I'm going to go over those. So you have, this was today's earnings report. So we're going to look at these real quickly. GE, Lockheed Martin, Raytheon, So let's look at these right now. Let me go to pull up the chart. Let me actually do this. Let me move this over. Okay, I moved it to another screen. And let's take a look at these. Everybody's been hot on the defense stocks because all the everything going on in the Middle East. But you have to ask yourself, hey, how much of that's priced into this move, or even this move here? This wasn't anything, didn't happen overnight. So all we can say is earnings speak. And I didn't do this video in advance, but you know how I work. If a chart's clearly bullish or clearly bearish, that's the direction I favor it going after earnings. And you can see here, you clearly had a negative divergence, a nice uptrend line, clean little rising wedge, and boom, it was broken today. And this is the way Lockheed Martin went after earnings. They were, again, reported this morning. That was and is my first target. We're on it now, first support level. If and when that goes, 562.54. And then there's a big old thin zone. There's just not a lot of support if that level goes. So either way, I wouldn't chase it on a 5% drop. I'm just kind of going over this for those of you in the sector or looking for levels. Let's say you're bullish. You want to buy pullbacks as support. You want to buy these. I wouldn't, coming off that big divergent high. Last time we had a divergent high was right here. The stock fell from that point 22%. So far, it's only down off the divergent high 6%. So, I'd rather wait I like to see divergent lows and especially at support right there. That's when I'd be looking to buy. But I want to just kind of give you an idea on the sector collectively, and then I'll wrap up with the ETF itself. So if you don't want to, again, most of them are out of the way now. You have, I think, another one reporting tomorrow. Here's RTX. They reported this morning. RTX Corp. What did I say, Raytheon? RTX Corp. There's the uptrend line. It's yet to be broken, but it's a nice, clean little wedge pattern. Last uptrend line I had was right here with a divergent high right there, right? That was our divergence line. I don't have it labeled, but that would say DH. You can see I had that line all the way back, created back in July of 2024. The uptrend line also in July. And boom, boom, boom. So now this one is dancing on dual support. You have this previous reaction high and the 123.24 level. You can see it's contained all the pullbacks recently and the uptrend line. So you want to see a solid break. That's a setup if you want to take it. It's a beautiful setup. There's a divergent high. It's untriggered. They're down at the post earnings, but not by much. Bearish engulfing candle in the works today right now. The body of this candle is engulfing 1, 2, 3, 4, 5, the previous 5 candles. If it finalizes this way. But that's the thing. We're only a few hours in the trading day, so anything can happen. I'm going to set an alert here, and I'll try to follow up on this later. All right, so again, there's another one that the market wasn't liking so far. One day doesn't make a trend, but so far the market wasn't liking what it was selling. So I already covered Lockheed. Yep, RTX. Let me see who else is there. That's it. All right, let me cover some others that reported today. We had Verizon this morning. Again, clearly a divergent high right there. Trendline break, just like you had last divergent high was there. We dropped, nice drop there. That was your last divergent low right there. And so that one went the way the charts were indicating. Who else reported? We had Triple M, 3M. I don't have it marked up. I did have a resistance line here. I created all the way back in 2020, and it smacked into that level today. It's flat right now, about 0.06%. It's basically flat, but it's got divergence. I don't have much of an opinion on that one because I don't see a clean uptrend line or anything. I'm just trying to, GE. GE Aerospace. Divergent high in GE Aerospace right there. Beautiful uptrend line. This is also a setup. So there it is, guys. There's a couple of them, like I just showed you, that they're down after earnings. This is down almost 8% on the day. Gap down and sitting on dual support, just like that other one. Who did I just show you? LMT, I think it was. Look at that, dual support. You had resistance, breakout to new all-time highs. followed by a back test right now of that resistance level, about 175.20. If that goes with conviction, you're also taking out an even more significant long-term uptrend line. And there's my minimum and first target, calling it back to the 200-day moving averages, plus 156.66, roughly, cover a little bit above. That'd be about a 10.5% drop right there if, from the 175-ish level. And then like a lot of other ones, it's just a big old thin zone right here. I think you can see the volume price histogram bars. They go out to here. The thin zone actually goes all the way down to here. Let me box it in for you. This is the thin zone. I'm trying to grab the box tool. Here we go. Right there. That's the thin zone. So that's a potential longer term swing target all the way down there to about 93. And if so, that would be a 45% drop. That take that. It's going to take a bear market. I mean, the world's not getting any friendlier, so I'm not sure GE's could. That's what the charts are indicating. I'd have to look at a weekly, and it would probably confirm it as well. Yeah, here's my weekly chart. I haven't updated this in forever. There's big. Yeah, let's just get rid of this old divergence line. It's too long, and just focus on here. This is what I showed you on the daily chart, and again, you can see it's pretty. You got some support levels here. It should hold on a pullback, but that's a steep wedge, and a lot of downside potential. All right, so let's move on. There's one that's who reported today. Tomorrow, let me just go over tomorrow's earnings reports. ENPH, I just clicked to the next day on the earnings calendar. I don't have much of an opinion on that one. That's a solar company, Enphase. STX, Seagate Technology, they make disk drives last I can remember. I don't know if they branch out to anything else, but they were always a big disk drive maker. They had a big divergent high back here and all there and set that trend down. It ended with a big divergent low. I haven't really traded or charted this one in a while, so I'm just showing you the levels. It's what it's done over the years. So these are the big trends: divergent high, drop, divergent low, rally, and a big divergent high right there. So they report tomorrow. My guess, based on the technical posture, the negative divergences, the overbought conditions, the cleanup trend line, that one goes lower post earnings. And again, they report after the close tomorrow. So I'm not saying tomorrow at 4:30 p.m., 5 o'clock. I'm saying in the coming weeks after the earnings report. TXN, we big semi reporting tomorrow. This one peaked already, divergent high. Had a divergent high there. It's not as if it didn't play out. It was good for about a 14% drop. When did it bottom? August 5th, like everything else. Hit the 200-day moving average, bounce, went up, put in a marginal new, but still divergent high, even bigger divergence, same from the same starting point. And so far, it's dropped down this level, 192.48. I've had that level back there since August. I created that back on August 30th, 2021, all the way back here. It was a key level, and you can see it's still a level that buyers and sellers are, it's acting as support. So if taken out, this thing already peaked here. It's at support. I wouldn't gamble on it myself because it's at support, but my guess is probably going to go down. It looks like a pretty solid top there. And it meshes with what I'm seeing on the semiconductor sector. So there it is. Remember, last time we had big here's the last two times. I'm just going to measure for you. And again, these are old levels. I put that back there. You can see divergent high, divergent high. That one was a drop of about 30%. This divergent high was a drop of about 26%. There was a small divergent high there, and this is a bigger divergent high. So, alrighty. Okay, those are the big ones. Those are those are after the close today. I'm sorry, these guys here. Tomorrow morning before the open, Boeing. Boeing. Whoa, big. I'm just marking this chart up now for the first time. Big divergent low. So that one. This would indicate a post-earnings pop. Again, I don't have a position. I'm not gambling. I'm keeping things light right now. Not married to this one. I'd have to study the longer-term charts, but just at the quick glance of the daily chart, that one looks good. KO, Coca-Cola, Peaked here, big divergent high. It's been moving lower since, but I could also see this one making a marginal move, still extending those divergences. So I'm gonna not really guess on this one. I'm gonna just gonna defer on trying to guess which way this one goes. I'm just trying to give you an idea of the big ones that report tomorrow. AT&T, I don't have it marked up. I don't have much of an opinion. And then tomorrow night after the close, that's a big day. Tesla already has had a problem. A couple failed attempts taking out. This is a weekly chart. This is our primary downtrend line. Tried but failed on a weekly closing basis. Had one marginal weekly close above it and back down below it now. So just a key level to watch. It's a triangle pattern. I don't have an opinion on it based on this chart, so I'm not going to try to call that one either. I can just tell you it has the potential to move the market. On that same day, this is again tomorrow night after the close, we have Lam Research, LRCX, if I can type properly here. This one peaked back here to put in a divergent high. Then it went on to break the trend line. It's dropped so far about 36%. It's got big divergence, positive divergence, but it's also coming off a big, when you look at a weekly chart, and this kills me, this charting program, I dragged this line down. It had a stock split, so all my lines get moved, and I have to do this, but I can, I had it here. We had a big divergent high on the weekly, so I have to just pull my lines back down, show you what you had here. The only lines that don't move on this charting platform is after a split are the lines on the indicators. It's only because the price level changes. But either way, this is a longer term bearish chart, and so you do have the positive divergence. All I can tell you, if we go down, we can go down a little bit, quite a bit, and still keep that divergence, but much more, it's going to be ugly. By the way, this isn't a bearish technical posture. Besides putting in a divergent high here on both the daily, weekly, sell signal there, we took out the key 200-day moving averages here. Once we did, we back tested, got rejected, back tested. So you can see here, let me turn off the lines. I have the 200 simple in blue and this 200 exponential in red. So it's really the exponential that's been capping everything. And when you're in a bull trend, that's where they buy it. You see the red line here, they buy, pullbacks to the 200. You're in a bullish trend when you're above them, and you're a bearish trend when you're below them. So really, this is where it changes for me. If you get back above the 200s, yeah, great. Semis are strong. This stock is strong, probably going to new highs. Until then, based on that, I'll have to bet it down, even though we have that potential positive divergence. And remember, you can get in a bear trend, a bear market, you're going to get divergences along the way that just don't play out, just like in a bull market where negative divergences can play out for either a little pullback or not play out at all. So, all right, let me see if there's anything else. The ones that we have IBM tomorrow after the bell too. Divergence, little clean trend line, which triggers sell signal there for you. Service now, NOW. So many of these charts are similar. Big divergent high right there. Trend line break, so I call that one down. T-Mobile, TMUS. There we go. Divergent high, just broke a minor trend line today. This is the more significant uptrend line there, and this is my target right here. So this one looks like it's headed down lower. 193 is your target. It's the intersecting price support plus uptrend line support. So that one, I would imagine within whether it's days, weeks, or months, is going to drop about 12% at least. And then finally, and I'll do this in another video, the miners, Newmont. I'd love to do this, an update in another video. See so many similarities with these guys. A lot of them have these little uptrend lines, like these little EKG lines. They're moving an uptrend, but these are the little pullbacks that you get along the way. And all along, we keep diverging. So we still have the big negative divergence, but we had, as I covered them, I believe, in the last video, we had quite a few whipsaws where you went down below and then you regained back above a trend line. But I will cover the miners and the metals in another video, because right now I'm at the 43, almost 44-minute mark. So I'm going to wrap this video up here and get it out to you, and then anything else I see that stands out. Oh, one thing, guys, I covered the semis early, and I meant to cover SMCI. I was just glancing another monitor. Remember that uptrend line I gave you recently? It broke here, and we're starting to go lower. So we broke. It was not clear to the masses, but now we're moving lower, so that increases the odds we come on down. And they've got a couple weeks till they report. Look at that, November 6th. So yeah, still maintain these first, and we effectively hit the first price target zone already, the top of it. But again, the bottom of it's also support. And then T2. All right, this has been Randy Finney with Right Side of the Chart. Have a great day.